Hey, good morning, everyone. This is Julie. Want to take a look at the 100 volatility on the JATS PT oscillator. So we've got the volatility oscillator showing by threshold and points per candle per time frame. This is on a 15-minute time frame. That there are 100 points per 15-minute bar. That is huge, huge volatility. So we maxed out at 100, just a little over 100, and the volatility started coming down. Yet the price kept coming down too, which is very rare. Also, when the volatility contracts, the range usually does not expand further. That's when the market makers are able to come in and push price higher. But I think since we broke the volatility range, that everything was off at that point. The next time I see that the volatility breaks 100 and decelerates for that particular session, I'm not going to worry about long trades unless I get long vol on it. You can see the market makers tried to come in here on this candle at 14:45 Central and did not make it. Got slammed on their head again and closed on the low tick. It is very rare to get 100 vol. There's only been a few times in history that the oscillator has registered that high. March of 2020 is one of them, and November 9th election. Here's the March of 2020, got up that high, and then the November 9th is another one right here. But this is screaming dip buy, right? In an ordinary, market environment. When you see vol get that high, usually the market is going to, retrace back up. This time, however, I am not a believer that that's going to happen. I think that we're going to continue moving down for a couple of reasons. So let me put some higher time frame charts up and we'll just walk through that real quick. So here's a weekly chart showing this huge weekly candle coming down, and you can see that we have not maxed out volatility. We have a little bit higher to go. 759.75, and we're at 712. So we have a little bit of room to go from this May 29th peak. And also, if I put the monthly distribution on the chart, you can see that we have a ways to go to reach our bottom fibs. And this area on the April 16th pivot looks like it's going to be support somewhere around that April pivot. And if you try to line it up with the tail 13,897, you can see that the support comes in right about there. So I think that we have a ways to go. Market is not quite reached this pivot low, 14,368.25. So once they clear those stops, we might see a bounce on this PT1, but realistically it could continue down further until we get to this ledge right here for the support. And so that's where I'm looking, 13,897 ish for the support area. Let's take a look at a daily chart, or a weekly rather, distribution real quick. Let me put this on a daily chart with a weekly distribution. So here's our target, and if I put a weekly distribution up, you can see that it's also at the bottom of the weekly tails. So it lines up real nicely to get us down there. Now we hit a tail almost to the tick for the weekly chart. Amazing how that works, isn't it? Bounced off the weekly one, came back and touched it twice, and then flushed down, and we're still flushing. There's no letting up at this point for a bounce. So I would be hesitating to advise anyone to start shopping technology at this point. In fact, I would say that we've got another, few hundred points, 500 points, 500 points to go. And that is how I estimate or guesstimate the ranges, just looking at this volatility. And you can see comparison wise on a daily chart that we have not maxed out the volatility on the daily time frame. We have room to go even further. However, on that lower time frame, the 15-minute, we maxed out on an intraday basis, and the market makers lost control of the market. I mean, clearly lost control of the market Friday with this deceleration of the volatility, yet price kept falling, 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 and the market makers could not stop it, which leads me to the conclusion that a higher power was trading this. These weren't just, puts or retail puts, in my humble opinion. They had to have been, central banks marking the price lower, in my opinion. So I think this might have been a coordinated effort, just guessing. I don't have anybody walking me through this or showing me. I'm just, following the price action, seeing that the market was decelerating and not accelerating into the sell-off. So that led me to believe that the banks and the market makers were not participating. They were getting their asses handed to them on Friday. They were not, trying to short this. They were trying to defend valiantly, however you pronounce that, and lost their shirts, is my guess. There's a lot of carnage out there on Friday as it kept falling and falling and falling with decelerating volatility. You could see that they gave up on the volatility, but the central banks or whoever, maybe it was retail, Robin Hood's selling puts. I doubt it. I really doubt it. I think it had to have been central banks marking the price down. So if they're marking the price down, then you want to go back to your higher time frame charts and try to figure out where are they trying to send it. And the first guess is this ledge for support, for support. and we'll see what that does. Now, if my theory is correct, then we're going to need to find a head and shoulders neckline, and that's going to be a perfect neckline also. So you've got your left shoulder, you've got your head, and then we would have a right shoulder, right? Bounce back up. So we would come down to the support area, bounce back up for a dead cat bounce, and then we would want to be looking to sell the rips for that break of the neckline, and we would want to take a one-time move at least from the high to the low and put it on the bottom of that. Is that right? I'm just doing this really quick, but someplace around 1125, something around there, right? So you measure from the high to the low, bring it down, one time move. There's your start of your head and shoulders. If that does break, that's where it will go. So technology just got a lot more interesting to trade and more fun. I think day trading. We'll be looking to sell the rips. And so anything with a daily range for selling the rips. And what that would look like would be anytime you got the opportunity to be above the one or at the one to come back down. So in selling the rips, this is what you're looking for. The reversal on the one. You might even get it at the 3, but anything between the 1, 2, and 3 coming back down, reversing on a sell the rip. And as you see, when price volatility gets normally above our 100 levels this December 19th. This is a 60-minute. This wasn't the 15-minute. You can see that normally signifies that the move is over, and you would look to buy the dip. But I think the dip buying is over, is what I'm trying to tell you. Don't see this high volatility as a dip buying opportunity. I think we have a lot more coming. At least 500 points, maybe. We'll see. We'll see how my prognostication comes. All right. It's kind of dangerous, saying things like this, because if it doesn't hold true, then I look like I have egg all over my face. But I really don't care. I'm just like you trying to figure it out. So, follow the flow. I'm just trying to point some things out. I'm not, telling you to buy or sell any place, but just giving you some hindsight of what I'm looking at from the volatility and that very unusual deceleration Friday, where you could clearly see that the market makers lost control of this market. They were not trying to sell this at all, and it just went from the one to the tails without them. Without, they lost 300 points. I wish I could have a banker tell me if I'm correct. If they had a hard time of it yesterday afternoon, I imagine that they did. I don't think that they were participating in this because of the deceleration of the volatility. They were trying to get this off and out That's why I got so excited and said that was a perfect V bottom. Normally that would have been a great V bottom. We had a nice float from the 1 to the 2, and then it turned around and went right back up inside the value, and that normally would have signified that this would have kept going. Instead, it turned around on this higher volatility right here. You can see the volatility going higher, hit 100, and then the banks and market makers just stopped selling, and it did not matter. They were buying, buying all in here, and it did not matter. They got their asses handed to them. Um, I'm just guessing central banks. I mean, it had to be somebody big. All right, you guys be good. Hope this helps, and preserve our capital as much as possible without getting um, our accounts blown up too many times in the process. When you get really, really high volatility like this, it might be better just to sit out of the market. In fact, anything over 70 would be a good guess to just sit on your hands. There will be plenty to trade directionally underneath 70, like normally. Most of the time, that's where the market lives. And if you get over 70, it can get really, the ranges can get so wide that it would cost you maybe, $5,000 on 200 points on one contract just to see if you're right or wrong in the direction. See how that whipped around? It's just too expensive for my budget to trade up there. So I can show you how to set your algos so that anything above 70 volatility on, say, a 15-minute chart, you can just say no signals. And that's real easy to set up. All right. Talk to you guys later. Thank you.